Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Sharkninja Inc. annual report. Sharkninja Inc. offers a wide range of products that cater to various needs of consumers. The company's product portfolio includes cleaning appliances such as corded and cordless vacuums, steam mops, and carpet extraction machines. In addition to these, Sharkninja also provides fans, coolers, frozen drink appliances, propane grills, and fire pits for outdoor use. The company's product line extends to cooking and beverage appliances like air fryers, multi-cookers, grills, ovens, coffee systems, carbonation machines, cookware, cutlery, kettles, and toasters. Sharkninja also offers food preparation appliances including blenders, food processors, ice cream makers, juicers, and frozen drink coolers. Furthermore, the company provides haircare and skincare beauty appliances, as well as home environment products such as air purifiers and fans. These products are sold through various channels including traditional retail stores, e-commerce platforms, distributors, and direct-to-consumer sales under the Shark and Ninja brands. Sharkninja Inc.'s stock price has experienced a significant surge of over 25.4% in the past year, reaching an all-time high closing price of $131.45 on February 17, 2026. The key driver behind this increase is the company's consistent strong financial performance reports. In its first quarter earnings report for 2025, Sharkninja announced a 14.7% year-over-year increase in net sales, surpassing revenue forecasts and leading to a 9.56% surge in the stock's pre-market trading. The trend continued throughout the year, with each subsequent earnings report exceeding expectations. The second quarter saw a 15.7% increase in net sales and a substantial 105.1% rise in net income, resulting in an 11.81% surge in the stock during pre-market trading. The third quarter reported a 14.3% increase in net sales and a 42.6% increase in net income, leading to an 11% share price increase. The final earnings report for 2025 was particularly notable, with record financial results including Q4 net sales growing 17.6% year-over-year to $2.1 billion, contributing to full-year net sales of $6.4 billion, a 15.9% increase. The announcement of an inaugural $750 million share repurchase authorization also signaled confidence in the company's financial health and commitment to shareholder value. These consistent strong earnings reports, coupled with optimistic outlooks and strategic initiatives like the share repurchase program, collectively fueled investor confidence and contributed to Sharkninja's stock price increase of over 25.4% in the past year. Sharkninja Inc. market capitalization of $16 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Sharkninja Inc. holds a significant advantage in their industry. Sharkninja Inc. trades at a higher price-to-earnings ratio of 28 times and a higher price-to-book ratio of 6.01 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, and the operating income have been increasing. This shows that the business model works and the business is expanding. The analysis of net income and profit margins reveals a mixed trend over the years. Initially, net income saw a significant increase of 162% from 2023 to 2024, followed by another substantial rise of 59% from 2024 to 2025. However, this growth in net income was not mirrored in the profit margins. the gross profit margin actually decreased from 48.1% in 2024 to 49% in 2025. On a more positive note, there were increases in profit margins between 2023 and 2024, with a notable rise of 6.2% for gross profit margin. The effective tax rate, ETR, also showed an improvement, decreasing by 1.3 percentage points from 23.4% to 22.1% between 2024 and 2025. This reduction in ETR contributed positively to the overall net income growth. Despite some inconsistencies in the data, it is clear that there were significant changes in net income and profit margins over the years, with varying degrees of success. The company's financial performance indicates a positive trend in its operating cash flow. According to page 84 of the report, the company generated $489.1 million in cash from operations under the 2023 revolving facility. Furthermore, on page 85, it is stated that net cash provided by operating activities for both 2024 and 2025 was substantial. The data on page 86 confirms that the net cash provided by operating activities exceeded the cash used in both investing and financing activities for the year ended December 31, 2024. This suggests a strong ability to generate cash from its core operations. Additionally, page 119 explicitly states that the company's operating cash flow status is positive. Overall, these indicators demonstrate that the company is indeed generating positive operating cash flow. The company has experienced significant changes in its financial metrics over the past few years. One notable trend is the reduction in debt levels. As of December 31, 2025, the total debt stood at $696,795,000, a decrease from $736,139,000 in 2024 and $775.5 million in 2023. This decline indicates that the company has successfully managed its debt obligations. Another key area where improvements have been made is in interest expenses. The net interest expense decreased by 24% between 2024 and 2025, from -$63,715 to -$48,600. Additionally, there was a notable decrease of $15.1 million, or 23.7%, in the year ended December 31, 2025. These reductions suggest that the company has been able to optimize its debt management and reduce its interest burden. Overall, these changes indicate that the company has made significant strides in managing its debt levels and interest expenses. The reduction in debt and interest costs is a positive development for the company's financial health and stability. The performance of various regions and segments within the company has been mixed, with some areas experiencing significant growth while others struggled. Regions that performed well include North America, which saw a notable increase in domestic net sales growth of plus 13.5%. The Asia-Pacific region also showed impressive results, with both net sales and royalty income more than doubling from $1.9 million to $16.8 million over the two-year period. In terms of segments, cooking and beverage appliances, food preparation appliances, and beauty and home environment appliances all experienced growth, driven by specific product lines such as the Ninja Luxe Cafe espresso machine and frozen drinks. However, not all regions and segments fared well. The United States faced economic challenges that led to a decline in consumer spending, while international markets struggled with competitive difficulties, merchandising issues, and resistance to paying for products. Within cooking and beverage appliances, certain subcategories such as core air fryers and outdoor grills experienced declines. Despite this, the company's general and administration expenses decreased by -10%, indicating some cost-cutting measures were implemented. The management of this company is optimistic about its outlook, citing significant revenue growth over the past 3 years. With a compound annual growth rate, CAGR, of 15%, the company is expanding its market share and increasing sales. This growth is likely driven by investments in research and development, which have increased by 7% year-over-year. The company's efficiency improvements are also noteworthy, with its gross profit margin improving from 48.5% to 49.2% over the past 3 years. Additionally, the management has announced a share repurchase program of up to $750 million, indicating confidence in the company's future performance and potential for further growth. The company's strategy appears to be focused on expanding its market presence through investments in new products or technologies, while also improving operational efficiency. The aggregation of domestic and international segments into one reportable segment suggests a unified approach to managing these operations. Overall, the management's outlook is positive, with a focus on driving continued growth and profitability. The company has made significant financial adjustments through its acquisition and divestiture activities. However, it appears that there have been no acquisitions made by the company during this period. One notable instance of a divestiture is the repayment of JS Global's outstanding debt under the facilities agreement, with a special cash dividend of $375 million. This move has likely helped to reduce the company's financial liabilities and improve its overall financial health. The company's financial activities have been notable in recent years. One of the key highlights is its commitment to returning value to shareholders through various means. On one hand, the company has a history of paying dividends, which demonstrates its ability to generate consistent cash flows and distribute profits to investors. On the other hand, the company has also engaged in share buybacks, another common practice among publicly traded companies seeking to boost shareholder value. By repurchasing shares from the market, the company can reduce the number of outstanding shares, thereby increasing earnings per share and potentially boosting its stock price. Concerns about inventory buildup or supply chain disruption are evident throughout the provided summaries. On page 25, both inventory buildup and supply chain disruption are mentioned as concerns. Page 30 highlights several issues that could lead to these problems, including excess inventory levels due to inaccurate forecasting of consumer demand, increased costs and limited availability of warehouse space, volatility in commodity markets affecting manufacturing costs, and lead times for critical components increasing due to global shortages. Additionally, page 33 notes the potential for supply chain disruption due to customs authorities detaining shipments based on forced labor concerns or suppliers being named to sanctions or restricted party lists. Retailers reducing inventory levels for products or designating more shelf space to competitors could also contribute to these issues. Seasonal fluctuations in product mix and retailer/distributor trade inventories, as well as potential conflicts with retailers due to expansion of DTC sales channels, are other concerns mentioned on page 35. The summaries also highlight the difficulty in managing supply chain and manufacturing processes, which could lead to inventory buildup or supply chain disruption. On page 36, it is noted that excess inventory may become difficult to manage, unusable, or obsolete due to shortened lead times for production. That concludes the financial summary for Sharkninja Inc. Feel free to comment below, and I will be happy to answer them when possible.